I feel like the next hour should be a therapy session for market participants. Live from New York City this morning. Good morning, good morning. Stocks are up. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Ferro.
Live from New York City, we begin with the big issue. What a messy week.
The CPI print yesterday was bad. It's really bad.
Inflation was supposed to be moderating.
The reality is that we're seeing inflation very hot.
We got a print that is moving in the wrong direction.
We're in a situation here where we thought the Fed had made a one-off adjustment to get to policy rates up to 4.75%.
This is presenting a real challenge for not only the Fed, but the broader economy.
Unfortunately, the data are pointing to a more systemic issue.
It is brutal. I think that's a good way to sum it up.
You know, wage pressures are pushing into prices now.
Now it looks like we're going into extra innings.
I definitely think we'll see another 75 basis point move in November.
Of course, what we're seeing is this repricing in markets.
The question now that we all have to ask ourselves is a 4.75% policy rate, is that enough?
That and how on earth have we rallied, ripped off the lows of yesterday? We'll get to that in just a moment. Mike McKee joined us alongside Kelly Lyons. Mike McKee, the data of the last 24 hours.
Very, very weird, very, very mixed. Inflation obviously still a problem. But this morning, we get word that retail sales were not all that bad. They were flat on a headline basis because auto sales were down just a little bit and retail or gasoline sales were down just a little bit. But look at the retail control group, up 0.4% for the month. That's basically what goes into GDP. And that was an improvement over the 0.2 gain in the month of August. So retail sales a little bit better, maybe boosted by the back to school spending. We don't know what the impact of Hurricane Ian is on these numbers yet, but we'll get a better handle as we get the revisions next month. But the other thing you have to take a look at is that the Fed's job is to clamp down on demand, and yet demand remains strong. Reasonably good retail sales. You look at the Atlanta Fed GDP Now numbers, they're expecting about 2.7% for the third quarter, and payrolls remain strong. So it definitely tells a story that the Fed hasn't done enough yet, or at least what the Fed has done hasn't started to hit the economy. So the question you raised about whether they have a target that's high enough is still a live question.
Mike, in some ways, you've got the easy job. Kelly Lyons gets the hard job. Kayleigh, you've got to explain, after everything Mike's just said, why on earth this market ripped the way it ripped yesterday and followed through in the same way today?
I'm not sure anyone can have a definitive answer to that question, John. There's a number of things you could potentially think about in theory, including just market mechanics, option activity, potentially some short covering. There also is, to Mike's point, about a softish landing, maybe more optimism building if some data is holding in there that the Fed might actually be able to pull this off. Another interesting point I read from Greg Valliere over at AGF was the idea that the inflation data of yesterday was so bad it may mean Republicans do better in the midterms, and therefore it's better for financial markets. I don't know which one's right. This market has been incredibly puzzling, and it's not just the equity market either. The bond market has been on quite a wild ride. Today it is that yields are moving lower. We're down about 6 basis points on the 10-year to 387. On the week, we're essentially unchanged in the belly of the curve and in the 10-year. They'll look at the short end, up 10 basis points on the 2-year, and that has everything to do with the repricing of expectations for the terminal that this market has held underway. Remember back in the beginning of September when we thought it was going to be 4%? We're now 100 basis points north of that. 5% ultimately on Fed funds is what the market is currently pricing in. Then, of course, the question becomes how long they're going to stay there. And if any softness appears in the economy, that will cause them to pivot, which comes back to the health of the consumer and what retail sales data realistically can tell us about it. I just want to issue a warning here that you have to keep in mind the impact of higher prices. And you see this at the corporate level. Pepsi earlier this week, volumes down basically across the board, 1.5% in total. Sales, though, up 16%. It is pricing power, John, going to be very important for this earnings season as well.
Kelly Lyons, thank you. Alongside Mike McKee, to the two of you, thank you very much. Futures right now up around 1%. Just keep your eye on some of the headlines coming out of Russia as well. Vladimir Putin in the last couple of minutes. This report, Putin saying that more massive missile strikes against Ukraine not necessary. More headlines still to come from that, and as they pour in, I'll bring them to you. Futures up again then. We ripped off the lows of yesterday. Zach Griffiths of Credit Sites joins us alongside Dan Suzuki of RB Advisors. And Dan, it's first to you. First up, you know where this is going. What on earth was that yesterday morning through this morning?
You know, I don't have a great answer for you, John, but I think it's a lot of technicals, a lot of algos into an oversold market. So you're bound to get those types of moves, but I wouldn't read too much of those. I think we really won't be talking about that move in a week or two from now.
Jordan Rochester over at Nomura said this morning, he had this quote, if it doesn't smell right, it probably isn't. Zach, is it?
It doesn't smell right, it doesn't feel right. And I think when we've gotten moves like this that didn't make a lot of sense off the back of either an FOMC decision or data like this, it has tended to reverse. And so I think I agree with Dan that this is certainly a huge issue and hard to explain right now, but we won't be talking about it a week from now.
Zach, what if you're wrong? How would you know?
Well, I think that as you kind of get into the end of the week here, sifting through all of the data, the hot inflation print is concerning, but does it really change what the Fed is going to do in the near term? And while the market is pricing a much higher terminal rate, we think that's probably gone a little bit too far. 75 basis points in November seems like a done deal. We think 50 basis points is still the most likely outcome in December and could still see the Fed pausing from there. So I think if we get a little bit more balanced message out of the Fed after a long week of very hawkish messaging, with the exception of Lael Brainerd, I think you could see that take hold and have a more realistic or balanced market reaction.
We'll hear from Governor Waller a little bit later this morning. Later today, the reaction to CPI from the Fed coming up later. Dan, I want to come to you on a big question. It's a debate you've explored within RB and on this program as well. Are we making this secular transition to a regime of higher rates and higher inflation? Because the conversations I have are often dominated by people who believe this period is just an aberration and we return to the old pre-pandemic playbook. I know you and the team have pushed back against that view, Dan. So what's guiding that debate for you and the team internally?
Well, John, I think, you know, we are in the camp that we are in a new paradigm of higher inflation and higher interest rates. You know, the problem for investors, you know, over the next 12 months is that, you know, we're dealing with major, you know, not just one, not two, not three, but four major macro fundamental transitions here. And that's just the first of them. I think, you know, so we're dealing with that transition. At the same time, we're dealing with a major transition in market leadership. You know, the old guard of U.S. large cap growth, we think that that's going away. And we're in the process of transitioning away from that. We're also in the midst of transitioning away from surging profits and abundant liquidity to what's likely going to turn out to be a profits recession with a lot less liquidity. And at the same time, you know, if Zach's right on his view, which we would agree with on the Fed and interest rates, we think that the drivers of interest rates are going to be shifting here from inflation in the Fed to that of growth over the next 6 to 12 months. So with all those moving parts, you know, it's very likely that it'll feel like over the next 12 months that the story of a higher interest rates and a higher inflation was transitory, is temporary, because at the end of the day, inflation's cyclical, interest rates fall alongside that, so they tend to be cyclical. So if growth slows, as we expect it will, you know, this secular story will feel like it's taking a break. But you saw that in the 70s, but they came roaring back as growth came roaring back.
Zach, does any of that resonate with you?
It does. And I think that we are having a shift higher in inflation and interest rates that could persist. And when we think about where we were prior to the pandemic, you had 1.5% to 2% inflation, perhaps 2.5% inflation is the run rate. And when you think about what that means for where the policy rate settles in, if we're able to get to neutral and stay there, perhaps we have more like a 3.5% Fed funds, whereas back in 2018, we got to 2.5% and had to reverse course. So I think there are some shifting dynamics in the market that will persist. But when you look at all-in yields from a corporate credit perspective, things are looking pretty interesting. And when you think about getting through these last 2 months of a very difficult year, looking ahead, things look like there's opportunities out there to get yield in places that had historically been much lower over the past couple of years. So we think things are going to look attractive, and you could even start to see spreads narrow at the end of this year and into early 2023.
So Zach, just help me understand the glide path for growth through next year. You expect spreads to narrow potentially into an economy that's still rolling over?
So we think that you're going to have slow growth below potential, but credit fundamentals are strong, and you're coming into a period where cash flow generation has been strong. Maturities over the next couple of years are reasonable. So while we do expect growth to slow, we're not calling for a recession at this point. And given the relatively sturdy fundamental credit backdrop, we think that results in a spread narrowing. Now, where we could be wrong, I think, is if inflation is even hotter than we expect, the Fed has to tighten more, and we go into a recession, in which case I think spreads narrow. And while you might still be able to eke out decent total returns, excess returns are going to be challenged in that kind of environment.
Zach, you're wondering what's going to happen with market functioning at all? Are you worried about that in any way, shape or form? Because the conversation we've had over the last couple of weeks has been primarily focused around what's happened in the UK. I've asked the question a few times. What are you more surprised by? The announcement from the UK government or the fact that $45 billion of tax cuts, £45 billion worth of tax cuts, has done this much damage to the market? Zach, I hear a lot about how resilient balance sheets are and how decent fundamentals are. And then I look at the fragility of the system over the last couple of weeks and I'm scratching my head, Zach, just how resilient is this system?
That's a great point, John, and that's something that we're certainly seeing in the Treasury market as measures of liquidity have gotten much worse as quantitative tightening has picked up. And so it's caused us to wonder, will the Fed have to reverse course on QT the same way the Bank of England did? And we don't expect to hear any big fiscal changes, even if there is a turnover to the Republican side with the midterm election. So it seems like for now, a big shift causing the Fed to stop its QT program or even start buying bonds. We're not expecting that at this point, but it's something that we're looking at as liquidity has worsened. It's even something that Secretary Yellen commented on recently after just a week or two ago, saying she hadn't seen liquidity issues. So it's definitely something that we're focused on, but from the corporate bond market side, we've still priced nearly $1 trillion plus this year. And so there is still liquidity out there. Deals are getting done, but we're going to keep an eye on that going forward for
Dan,
sure.
it's something I've asked as well. Now, please, Zach brought it up. Is QT still going at the Fed when we kick off 23? Is that something they have to abandon? We've seen what's happened with the Bank of England. We've seen the struggles with the ECB earlier this summer. They had to come up with a mechanism to cap yields on the periphery. Dan, do you think they're still doing QT in 23?
I think they probably will be, but you make a really good point, John. I think, listen, there's this kind of, saying that's going around that everybody's talking about. The Fed's going to keep raising rates and keep tightening until they break something. We're getting closer to that breaking point more likely. I mean, you've already seen sort of a shot across the bow in the UK. If rates do go much higher or the economy slows much more, or the markets go down more, it's likely that you're going to see more stress in the system. And those signs of stress are going to potentially give the Fed pause. That's not our base case scenario. But, the more that we go down this road, the risk of those type of events is certainly increasing. That's the type of thing that would get the Fed to reverse course.
Hey, Dan, Zach, stick with us, won't you? We heard from Mr. Hartnett of Bank of America a little bit earlier this morning. He called it a bear hug. I think a hug from the bears for the bulls, perhaps. This is what he said. In addition, at the big low, which he expects in 23, not this year, everyone expects the Fed to cut. Just ain't the case today. The market is so oversold and investors are so cashed up, it adds up to a decent counter rally, but the ultimate lows ain't seen yet. Michael Hartnett of Bank of America. Futures right now up about 1 full percentage point. Coming up on this program, what are 24 hours for Kwarteng?
What I'm totally focused on is on delivering on the mini budget, making sure that we get growth back into our economy. I'm not going anywhere.
Well, he just got sacked. That conversation up next.
What I'm totally focused on is on delivering on the mini budget, making sure that we get growth back into our economy. I'm not going anywhere.
Well, he is now. That was yesterday. British politics, absolutely brutal. Chancellor Kwarteng accepting a request from Prime Minister Liz Truss to step down. A news conference expected in about 15 minutes from now, along with a potential reversal of her economic plan. The team coverage starts right now with Lizzie Burden on number 10 Downing Street and alongside Guy Johnson in London. Lizzie, first to you. Is the Prime Minister next?
Well, interesting comments from Philip Hammond, the former Chancellor, earlier. He was saying that I quote, "I hope the Prime Minister doesn't think the problem can be solved by getting rid of the Chancellor." But he also said that he thinks Truss can survive because he doesn't think that the Tories would want a general election, because as the polls suggest at the moment, it would be total wipeout for the Conservatives and it would be a new era for Labour.
Lizzie, can you guide me through what happens in 14 minutes? Do we get a statement? Is it a news conference? Are there questions? Do we get the reversal of the economic plan? What is next?
We are expecting questions after a statement. The fact that Liz Truss has sacked Kwasi Kwarteng, and we did actually see him leaving number 10 Downing Street in a car earlier, down into the street of where there's an Extinction Rebellion protest, the climate change protesters. We're expecting, because she sacked him, it gives political cover to make big reversals on this mini budget, much further than just the corporation tax cut. And really, she's going to need to do that, since she said she won't cut public spending further if she wants to balance the books and restore market credibility. We may also hear more about the sackings at the Treasury. It's been announced that Chris Philp, the Chief Secretary to the Treasury, is being replaced with Edward Arger. It could be curtains for Jacob Rees-Mogg, the Business Secretary, as well. A bit of a Treasury bloodbath, because really this is the moment where Liz Truss needs to reset her government if she has any hopes to stay in number 10.
And Guy, here was me thinking we'd be talking about Governor Bailey today.
Yep. Well, I don't think his job's completely over yet. We'll see what happens on Monday morning. But certainly the movements in the gilt market does make the governor's job a little bit easier. Will we need to see further announcements from him next week? We will wait and see. Could we see some sort of temporary halt, maybe, John, to the QT programme? In some ways, that would be logical. I think we'll wait to hear from Jeremy Hunt. Not entirely sure where Jeremy Hunter is right now, but we'll wait and see what exactly happens in terms of his appointment and what policies he's going to be pursuing. This feels like a coalition. This is like a coalition government now, John. You've got the Truss wing and the Sunak wing effectively in power together in the form of Jeremy Hunt and Liz Truss. It's going to be really interesting to see how ultimately this works and the kind of policies that he's going to bring. He's much more centrist. Will the government allow him to deliver what he wants to deliver? Will the markets accept what he wants to deliver? I think there's a lot of unknowns still here, and that's going to make life a little bit more difficult for the Governor of the Bank of England.
Guy, I'm pleased you went to policy at the Bank of England. Of course, the operation is supposed to end today, the gilt market operation announced in the last week or so. What's happening at the end of the month is QT. Steve Major of HSBC wrote in the FT earlier this week that there might be a ways around this, that they can maybe tighten up the maturities that they use to sell, perhaps at the front end, given the average duration of the gilt market is something like 13 to 14 years. Maybe the DMO, the Debt Management Office, can bring that in as well, Guy. Can you go through the options available to both the DMO, the Treasury and the BOE as they go forward from here?
There is certainly more demand at the front end. The UK has extended out its maturity profile quite significantly over the last few years. There is probably more demand at the front end. How the bank would manage that, I think, would remain to be seen. But certainly it seems slightly counterintuitive, doesn't it, to basically support the long end over a limited period of time and then effectively within a matter of days be effectively selling back into that longer duration portion of the market. So maybe we do get some sort of a tweak here in terms of the strategy vis-a-vis the duration that is going to be part of the QT program. Or maybe they just put the whole thing on hold for now and basically focus mainly on raising rates. I don't know yet, but whether or not those two things can be made to be compatible, I think remains to be seen. And I think that's the challenge for the Bank of England at this point.
Hey, Guy, let's catch up soon alongside Lizzie. Lizzie Bird and Guy Johnson. No doubt we'll catch up with them in a few minutes' time because we're set to hear from the Prime Minister in about 10 minutes' time, potentially. Zach Griffiths, Dan Suzuki back with us. Zach, how long does it take to rebuild the credibility that's been lost in the last couple of weeks?
It's been a wild couple of weeks, and you have to imagine it's going to take some time. Certainly, they're taking steps that needed to be taken. It'll be interesting to see what actually happens with the policy they put forth. That's certainly going to be key, and the Bank of England dodged a bullet. I was with you, John. I could not believe that Andrew Bailey made those statements earlier this week, but it seems like he's on the winning end so far. Again, we'll see how things go on Monday. I think we're going to still see a lot of volatility from here, and it's really going to come down to how the fiscal policy plans change going forward.
Dan, I want to tie this into the equity market as well and go back to an earlier point of yours. You're thinking about how the leadership might change in equity markets, the next regime of this. And typically the allocation was very, very biased towards the US over the last 10 years. precisely because that's where the big tech heavyweights were. It was about the breakdown of the weightings of the S&P 500. Dan, as I think about international, if that's part of this new leadership story, perhaps, I'm looking at Europe, which is in a mess. I'm looking at the UK, which is in a mess. And I'm looking at China, which is deep, deep, deep into the unknown. Dan, is the international story part of the new leadership in the next regime?
Yeah, I think it's certainly a part of that story. I think there's a lot of reasons to believe international is going to do phenomenal over the next decade. Certainly it feels bad now, but that's always how it starts. I mean, that's why, there's a scarcity of capital in these markets. Go back to the wake of the tech bubble in the U.S. I mean, U.S. was, blowing everybody away. We had just come out of the Asian financial crisis, yet that ushered in the leadership of emerging markets for the next decades, right? So I think you could very much see, what was crisis now, normalizing away over the next 10 years, and that being a big part of the story for international. But it's not just that story. I mean, you have this massive move in currencies, which is unlikely to continue, over the next 10 years. So currency can go from a major headwind, for those markets to a tailwind. At the same time, valuations, which is a terrible timing indicator, but a very powerful predictor of long-term returns, is giving you fire sale prices on most regions outside the U.S. I mean, the rest of the world, trades at like 10 or 11 times earnings. You're hard-pressed to find a market that trades above 12. People are talking about how cheap the U.S. has gotten when it's only back in line, more or less with its historical average. So if valuation is the best predictor of long-term returns, and you also have, this horrible sentiment toward international, and there's reasons to be optimistic on growth, to be optimistic on currencies, I think that's a recipe for some outperformance in a lot of these regions.
Gents, get some rest. We've got to do this again on Monday. Dan Suzuki, Zach Griffiths, to the both of you, thank you. Equity futures right now up 8 or 0.9%. B of A said it in the last week. Forget 3Q, it's all about guidance for 4Q and beyond. Jamie Dimon at JP Morgan just moments ago, expecting lower investment banking revenue in 4Q versus 3Q. That conversation up a little bit later. Up next, the morning calls. And around the opening bout, the big banks coming out with earnings. That conversation with Baird's David George, Sonali Basak on deck with us too, and the view from Judy Beale of Kane Anderson Rudnick. The opening bout up shortly. Live from New York, let's get you some morning calls. First up, UBS raising its Netflix price target to $2.50, expecting its new advertising plan to boost revenue by another 10%. Credit Suisse downgrading Stanley Black & Decker, expecting rising rates to weigh on home sales and housing-related products. And finally, Cowen upgrading Delta, highlighting the airline's improving outlook. That stock is up by 3.5%. Coming up shortly, the opening bow and possibly the Prime Minister of the UK expected to speak at number 10 Downing Street. Live from New York, this is Bloomberg. In just a moment, you're going to hear from the British Prime Minister. We'll take that news conference right here live on Bloomberg Television. Going into the opening bell, futures elevated up 0.75% on the S&P 500. On the Nasdaq 100, up 0.9%. We ripped off the lows of yesterday, and we had some more weight back into the S&P and the Nasdaq. There's the opening bell. Switch up the board and get to the bond market. Yesterday, yields absolutely surging at the front end and right the way through the curve. Your 10-year right now backtracking down 6 basis points to 388. 388.10, call it 388.30. Sterling very much in focus as we wait to hear from the British Prime Minister. 112.31, negative 0.8%. And to round things out for you, crude 87.32, we're down by 2 percentage points. The big banks with earnings this morning: JP Morgan, Wells Fargo, Morgan Stanley, Citi. Not my job to keep up with this. It's Sonali Basak. She joins us now. Hey, Sonali.
A lot to parse through, John. And let's start with some of the biggest topics on Wall Street. Savings rates was one of them. JP Morgan asked right off the bat whether you're going to see higher savings rates for consumers and therefore an impact on their deposit betas. Listen, they said it depends on competitive positioning, plus that lag in interest rate rises. So let's see how much those actually go up for consumers. I want to also talk about the areas that Jamie Dimon sees cracks in the market. He says he doesn't necessarily see systemic systemic risks, but he drew some areas of concern, and that includes in the dollar and emerging markets, in credit, and he talked about leverage loans as well, though he said that the market isn't yet to clear, but JP Morgan is not heavily exposed to that market. So that can explain to you a little bit why you didn't see a lot of write-downs in this quarter. You didn't see it from Morgan Stanley, you didn't see it from Citigroup, but the question is, roll forward into the fourth quarter, are they going to take those write-downs moving forward? Now, on their securities portfolio, that $1 billion worth of markdowns that you saw is JP Morgan in the market here. They bought some securities, they sold some securities, especially when it came to mortgages. Jamie Dimon has told investors that it's good for them, it's good for their capital return. He's getting questions as well, John, about what future profitability looks like.
Yep.
He said he's going to do damn good in a recession. Let me clarify that for a second. Am I allowed to say that on television?
I think you can. You just did.
Sorry, Julie. And so if we do, what he means by that is they may adjust their 17% return on tangible common equity goal a little bit, but they should be able to reach that goal in the face of all these headwinds that he has consistently outlined.
I understood the sentiment. It was well received. Shanali, we're going to do this all over again on Monday, OK?
We are.
Shanali Basak, thank you. Joining us now, Baird's David George. David, you'll have to bear with me, sir, because in a moment I have to go and hear from the Prime Minister in the UK, and when that starts, we're going to break away from this. But David, first of all, your number one takeaway from this morning, please.
Overall, the results were very good. Net interest income, really the bright spot, and really showing the true leverage of these Fed rate hikes on bank earnings, and it's having a meaningful impact on revenue trends, and we've seen that flow through this morning.
You've got a good forward look on the fourth quarter and beyond, David?
Well, on the market side, John, it's obviously a bit unknown, although I think this volatility is actually good for FICC and good for trading so far in October. But there is very positive implications for net interest income in the fourth quarter as banks continue to get that full benefit of these Fed rate tightening.
David George, right on cue, is the Prime Minister of the UK.
My personal experience. I know what it's like to grow up somewhere that isn't feeling the benefits of growth. I saw what that meant, and I'm not prepared to accept that for our country. I want a country where people can get good jobs, new businesses can set up, and families can afford an even better life. That's why, from day one, I've been ambitious for growth. Since the 2008 financial crisis, the potential of this great country has been held back by persistently weak growth. I want to deliver a low-tax, high-wage, high-growth economy. It's what I was elected by my party to do. That mission remains. People across this country rightly want stability. That's why we acted to support businesses and households with their energy costs this winter. It's also the case that global economic conditions are worsening due to the continuation of Putin's appalling war in Ukraine. And on top of this, debt was amassed helping people through the COVID pandemic. But it is clear that parts of our mini-budget went further and faster than markets were expecting. So the way we are delivering our mission right now has to change. We need to act now to reassure the markets of our fiscal discipline. I have therefore decided to keep the increase in corporation tax that was planned by the previous government. This will raise £18 billion per year. It will act as a down payment on our full medium-term fiscal plan, which will be accompanied by a forecast from the independent OBR. We will do whatever is necessary to ensure debt is falling as a share of the economy in the medium term. We will control the size of the state to ensure that taxpayers' money is always well spent. Our public sector will become more efficient to deliver world-class services for the British people. And spending will grow less rapidly than previously planned. I met the former Chancellor earlier today. I was incredibly sorry to lose him. He is a great friend, and he shares my vision to set this country on the path to growth. Today, I have asked Jeremy Hunt to become the new Chancellor. He's one of the most experienced and widely respected government ministers and parliamentarians, and he shares my convictions and ambitions for our country. He will deliver the medium-term fiscal plan at the end of this month. He will see through the support we are providing to help families and businesses, including our energy price guarantee that's protecting people from higher energy bills this winter. And he will drive our mission to go for growth, including taking forward the supply-side reforms that our country needs. We owe it to the next generation to improve our economic performance, to deliver higher wages, new jobs, and better public services, and to ease the burden of debt. I have acted decisively today because my priority is ensuring our country's economic stability. As Prime Minister, I will always act in the national interest. This is always my first consideration. I want to be honest, this is difficult, but we will get through this storm, and we will deliver the strong and sustained growth that can transform the prosperity of our country for generations to come. I'll now take questions. Can I start with Ben Riley-Smith, Telegraph?
Thank you, Prime Minister. Clearly a difficult day. Can you explain to the public why you think you should remain as Prime Minister, given you jumped a key tax cut that led you to be elected and got rid of your Chancellor?
I'm absolutely determined to see through what I have promised, to deliver a higher growth, more prosperous United Kingdom, to see us through the storm we face. We've already delivered the energy price guarantee, making sure people aren't facing huge bills this winter. But it was right, in the face of the issues that we had, that I acted decisively to ensure that we have economic stability, because that is vitally important to people and businesses right across our country. Harry Cole.
Thank you, Prime Minister. Harry Cole from The Sun. You were the one that wanted to cut the 45p rate. You stood on a platform to win the leadership of the Conservative Party on a platform to cut corporation tax. You and the Chancellor, the ex-Chancellor, designed this budget together, in lockstep, we're told, at times in secret, the two of you. He has to go because of the fallout from it. How come you get to stay?
Well, my priority is making sure we deliver the economic stability that our country needs. That's why I had to take the difficult decisions I've taken today. The mission remains the same. We do need to raise our country's economic growth levels. We do need to deliver for people across the country. We're committed to delivering on the energy price guarantee, which people are already seeing in their bills. But ultimately, we also need to make sure that we have economic stability, and I have to act in the national interest as Prime Minister. Chris Mason, BBC.
Excuse the bluntness, Prime Minister, but given everything that has happened, what credibility do you have to continue governing?
What I've done today is made sure that we have economic stability in this country. Jeremy Hunt, as Chancellor, is somebody who shares my desire for a high-growth, low-tax economy. But we recognise, because of current market issues, we have to deliver the mission in a different way. And that's what we are absolutely committed to do, achieving that stability at what is a very difficult time globally. Robert Peston.
Prime Minister, the former Tory Chancellor, Philip Hammond, has just said that you have totally trashed the Tory party's election-winning reputation for economic competence. Will you apologise to your party?
Well, I am determined to deliver on what I set out when I campaigned to be party leader. We need to have a high-growth economy, but we have to recognise that we are facing very difficult issues as a country. And it was right, in the national interest, that I made the decisions I've made today to restore that economic stability so we can deliver, first of all, helping people through this winter and next winter with their energy bills, but also making sure that our country is on the long-term footing for sustainable economic growth. Thank you very much, everybody.
Aren't you going to say sorry?
Abrupt questions, short answers. The Prime Minister, Liz Truss, Lizzie Bird and Guy Johnson back with us. Guy Johnson, your reaction, sir?
That was very short, wasn't it? She was basically asked the same question 3 times. Why should you continue in post as Prime Minister? And to be honest, she didn't look overly convincing in her answers. I think she is going to struggle. She has clearly put Jeremy Hunt in place in order maybe to provide cross-party unity. Whether or not that ultimately gets delivered, we will wait and see. But Liz Truss looks like she is rattled, would be my sense. She was looking around the room looking for people that didn't feel like a particularly slick performance, did it? She feels like she's rattled. She's just had to sack her Chancellor, one of her closest party friends within the Conservative Party. They've been very close for a very long time. They have been putting these plans together. She sacked the Chancellor. Does she ultimately need to go, I think, is the question that a lot of people are going to be asking after that performance.
You heard it asked in the news conference. Lizzie, she's got to come up with a better answer for this. Why is getting rid of the Chancellor in the national interest, but stepping down is not?
Yeah, and what I heard from what she just said was that it's exactly the same vision, but it needs to be made palatable to markets to get it through. And that is why she's had to sack the Chancellor. And there was more of an appeal to markets there, and a need to reassure markets. But I wonder whether markets will still want to be on board with the overall vision for Trussonomics, because at the heart of it, even though she's saying that she's now going to raise corporation tax, it's still Trussonomics. And it's stunning that she is going to raise corporation tax, because just reading from something she said at Prime Minister's Questions only on Wednesday, I feel it would be wrong in a time when we're trying to attract investment into our country and a time of global economic slowdown to be raising taxes. So, this is really undermining to herself. We have to wonder whether markets will buy it. And even if there was a little rally when we heard that Kwarteng was going to be replaced and when there was going to be this U-turn on corporation tax, fundamentally, the economic credibility has been undermined. The BOE's had to step in. So is it too little too late?
Well, I can tell you, sterling rolling over here at 111.96. We're down about 1% on that currency pair, but read whatever you want into that, because cable's been all over the place in the last week. We've had lows of 103.50 just a couple of weeks ago. We were through 112 early this morning, through 113 even. Guy, I'm pleased that Lizzie turned to policy, so let's sit there on policy. There was a reversal in there. It was the planned freeze on corporation tax, a reversal on that. They were going to try and hike that maybe a couple of months ago. Now we've got the backtrack. Guy, can you tell me if we're going to see a reversal on any other initiatives whatsoever? Because I just see one, the reversal on a planned freeze on the corporation tax. Where's the rest of it?
So if you're looking at balancing the budgets, corporation tax is one element of it. The NI cut as well, the national insurance cut, is obviously a huge other element to it. The top rate of tax was, from a fiscal point of view, largely irrelevant. It was a political blunder that they decided to get rid of that. So whether this goes far enough, we'll wait and watch. But if that's it, then this doesn't feel like a sort of wholesale reversal, as you say, of, and as what Lizzie was saying, of what was originally announced. Does this go far enough? I think the market, I think you're right. The market is going to take a little while to judge what is happening here. And I think we need to hear from Jeremy Hunt. I don't know where Jeremy is, but we'll hopefully hear from him soon. I think he was sorting out Farnham Lane rather than sorting out the entire country. So I think we're in a position here where we need to hear from Jeremy Hunt. He was against, so what is interesting is that Jeremy Hunt was against raising corporation tax. He was in the camp when he was campaigning for the job of saying that actually what we need to do is cut corporation tax and raise other taxes. We've ended up with almost the exact reverse of that. So it's going to be interesting to see how he kind of manages that process. So I think at this point we need to wait. We've got the sacking of the Chancellor. We've got Truss coming out with a pretty unconvincing statement. I think we need to hear on the 31st or maybe earlier from Jeremy Hunt to get a full idea. I don't think they've got a fully thought out plan, John. I think that I said this earlier on in the day.
I agree with you.
This is not a fully formed plan at this point. They are making policy on the hoof. They decided on corporation tax, but that's about it at this point. They have not got a fully thought out plan that they think will work, A, for the markets and B, for the party.
So, Lizzie, let's go there. And I know this is tough to answer, but the incoming Chancellor, Jeremy Hunt, we understand he's going to deliver the medium-term fiscal plan at the end of the month. As Guy said, October 31. Are we going to hear the budget that he would have delivered for, say, Sunak, or is this just a mix of both?
I think Guy's right to characterise Jeremy Hunt as somewhere between Truss and Sunak, and that's precisely why we're expecting she's picked him to try and reach out to those other parts of the party. In his bid for leader, he said that cutting business taxes won't stoke inflation. Tackling inflation has to be the main challenge. So you can see where he sits there, but we don't know what he's going to be like as Chancellor really yet. If he's serving under Truss, he's going to have to, in a way, show that he is still delivering that vision. You heard in the press conference, the Telegraph was asking, almost disappointedly, if you're going to make reversals, how do you still get to stay as Prime Minister? So there's this big wing of the Tory party that does actually want to see, the membership that voted for Truss wants to see her carrying out her tax-cutting vision.
Got to take a step back here, Guy, as well, and talk about what's happened with markets, something that may not have happened in the QE era. We've seen markets push back. Mohamed El-Erian was on the show with us earlier this week. He wrote it in a Bloomberg opinion column. The vigilantes are back. Guy, do you think we're going to see more of this?
Absolutely. I think the whole problem here was that we were in an environment where the market was clearly concerned about inflation. And that was blindingly obvious. To put a policy into place that only exacerbated that was going to get a very sharp reaction. And I think that politicians globally are now going to be aware of this, that they need to tread carefully. We are now back in the era where if you want to be reincarnated as being all-powerful, you come back as the bond market, because clearly we are now seeing that that is where the power now lies. The UK has been the first kind of example of this. There will almost certainly be others. I imagine the Meloni government in Italy is treading much more cautiously as a result of what is happening here. Other governments will be paying attention as well. Markets can move. Before we were moving markets, bond markets were moving in very small increments. There was very low volatility. But as we've now seen, you can get huge volatility events that can erupt very, very quickly.
Makes me think, Guy, just how much fiscal space we have to deal with issues going forward from here. One question that I've pondered, and Guy, I know you've done the same thing over the last few weeks. What surprised me more rather, is not the announcement by the British government, just the way this market responded to £45 billion worth of tax cuts. Now, Guy, you said it, your words. These were febrile markets. The timing was not great. But, Guy, I do wonder, we've got a big initiative coming out of Europe to try and offset some of the energy pain. We've still got a big initiative coming out of the UK as well. And these central banks, guys, you know, are still very, very keen on tightening up policy.
They are. But... and I think this is going to be the challenge for the Bank of England almost on Monday morning. How do you manage this when you have, as we've discussed, febrile markets? You've got markets that are super sensitive. Is QT going to be a policy that ultimately will have to be withdrawn in this kind of environment? Can you manage withdrawing the balance sheet, reducing the balance sheet in this kind of environment? Can you raise rates as aggressively? I think duration really matters here, John. I think it's over what period of time. And I think that's something that we've all got to try and figure out. How quickly do we want inflation to come back to target? How quickly can we get inflation back down to target, 2%, circa 2%? And is the time period in which that needs to be managed longer than we originally conceived that it might be? Maybe you can do all of this, but maybe it will just take longer than you originally thought. We're seeing an awful lot of aggressive front loading at the moment. We're back to the kind of 1980s, certainly with the Fed policy that we're seeing, and others as well. Is that time frame simply too aggressive?
Yeah.
After the years and years of very, very low interest rates.
So, Guy, there's 2 points you're making here. One is, what is the appropriate time horizon to return inflation back towards target? Jean-Paul Van of BlackRock has written about that in the last few weeks. But I think the more important point here is, what is the nature of the shock, Guy? Is it a one-off shock, one winter, one war, inflation absolutely ripping, and then we go back to where we were before, perhaps in 12 months' time? Or is this a secular shift to higher rates, higher inflation? And are we seeing a permanent structural adjustment away from, say, sources of Russian energy? Now, Guy, if it is the latter, then you have to wonder how sustainable some of these policy efforts are coming from these governments right now.
I think I've heard you talking about this throughout the day. There is a large argument that says that we are going into a new paradigm, that we are not going to simply return to the low volatility environment we had before that effectively was suppressed by central banks. I think that's going to be incredibly difficult to achieve. There are lots of structural forces, I think, on the move at the moment, John. You've got deglobalization, you've got the energy story, you've got an energy story that's going to take longer to sort out maybe than a lot of people think at this point. Moving to a lower carbon energy sort of plan is going to take maybe decades. It's certainly not going to be achieved overnight. We're changing our policy with regards to China, and it's interesting to see where the UK sits in all of this. So all of this is incredibly structurally, you would have thought, inflationary. So it's going to be much more difficult for central banks to operate with that very low environment, low rate environment. I don't think we're going back there. I think the environment looks to be very different going forward. And I don't think it's just one source of change that we're seeing here at the moment. There are multiple points of change. And I think that's going to make it very difficult for markets to navigate this and to fully understand ultimately what that means for policy. I think policymakers are still trying to figure this out as well. I don't think they've got a rule book or an understanding of ultimately how they are going to respond. So again, we're going to see volatility in policy as a result.
I think we're all struggling with this one. Lizzie, I want to give you the final word. Where this leaves Governor Bailey Monday morning after this gilt market operation ends today.
Well, I think Andrew Bailey's got to be creative here. I was speaking to former BOE policymaker Martin Wheel about what he could possibly do. He suggested targeted support for pension funds that need the help. But Andrew Bailey needs to get out of this situation where he's beholden to fiscal policy and prioritising financial stability over inflation fighting. He knows that. The IMF's told him that. I think if the market volatility continues on Monday, he'll be looking for something other than the blunt tool of QE.
Hey, Lizzie, fantastic work today. Lizzie Burden, Guy Johnson. Guy, I know you'll pick things up in about 7 minutes' time. Looking forward to that. Guy Johnson there and Lizzie Burden. Chancellor Kwarteng is out. Jeremy Hunt is in. Can Liz Truss hold on? From New York, this is Bloomberg. James Gorman of Morgan Stanley moments ago said the environment was difficult, but we're not stressed. I wonder if you feel the same way. Equities right now just about positive on the S&P, up a third of 1%. That's the price action. Here's your trading diary. The UMich Consumer Sentiment Survey at the top of the hour. More Fed speak, George Cook, Waller, all on the agenda. Plus President Biden discussing US inflation at 6 p.m. Eastern Time. Fed President Jim Bullard speaking from the IMF on Saturday, followed by Kashkari next week. And finally, more bank earnings to kick off Monday morning. From New York City, thank you for choosing Bloomberg TV. This was the countdown to the open. This is Bloomberg.